Okay, so we continue on master budget. Okay, we already covered anti-sales budget. Okay, let me go through scroll here so that we can skip sales budget. Okay, sales budget we already covered last lecture class, right? So what we need to know in the sales budget is we have to know the unit. How we how we want to get the unit is through sales forecast. And normally it was stated in your question. So sales unit and the selling price per unit. So we can from this table sales budget we can identify the total budgeted sales. That's mean for April we budgeted 200,000. In May we budgeted 500,000 of sales. June we budgeted 300,000 of sales. Okay, quarter we for that quarter, which means April, May, June, we targeted 1 million. So for this quarter, okay, if you remember, we learn in accounting, right? We learn in accounting all this sale will be on credit. Okay, we assume all this sale will be on credit, and we have that collection period, right? We have that collection plan. Some of the plan it can be okay. This month, the plan will be okay. This month, customer need to pay 15%, 50%. Next month of sales, customer need to pay 50%. So after we do the sales budget, we need to do the cash collection. Okay, cash collection budget, which means this cash collection we actually will post it to cash budget. So that's why we have to create one cash collection budget in order to identify how we want to collect this 200,000. Okay, it can be 50% on the year month of sale, another 50% next month, or maybe 50, 20, or 30. So it depends on the package or the system that the company has recreated. So, okay, we continue with expected cash collection. Okay, we assume all sales are on account. Okay, royal collection pattern is 70% collected in the month of sale. Okay, if the sale is April, so 70% were collected in April. Okay, 25% collected in the month following sale. Okay, that's mean on May we will collect another 25%, and 5% is uncollectible. So that's mean this is together with the bad debt, or together with provision of doubtful debt. Okay, okay. In April, the March 31st account receivable balance was 30,000 will be collected in full. Okay, sometime this is May, right? April, May, June. Okay, so April will be collected 70. On May we collected 25. So if you look here, okay, we highlight. Okay. We highlighted here. So want to highlight. Okay, now we highlight. In April, the March 31st account receivable balance 30,000. So when we do this cash collection, April, May, June, the beginning balance on April will be 30,000. Now we look at the sales of April. Okay, we look at sales of April. The sales of April is 200,000. So 70% will be collected on month of April, so 140,000. The following month will be collected 25%, which means the remaining 50,000. Okay, so this is the April sale. Okay, how about May sale? Okay, May sales, 70% is total of 500,000. Okay, where we get this number is from the sales budget. Okay, 70% of 500,000 is on May will be collected 350,000, and 25%, which is in the following month in June, will be collected 25%. Okay, this is done for May sales. Okay, how about June sale? Okay, June sale. In the June sale, 70% on that month, on June, okay, on June, 210,000, but another 25% will be collected on July, which is other quarter. So this is the amount of sale that we collected on that month. Okay, doesn't mean that the sale is on April, we will get 200,000. No, sometimes the company set the system or something like this. Okay, 70% pay, 70% you will pay on this month. Another 25% you can pay next month. Okay, so from here we can identify how much cash collection, how much the cash collection for April. So this 170,000. Okay, on May, 400,000, and June 335,000. So the total is 905,000 for the whole quarter. So all these cash collection will be posted into cash budget. Okay. All right. Do you understand until now? Do you understand how we collect the sales? So this one is part of cash budget. Do you understand? Okay, we can continue to, okay, now we can continue to production budget. Okay, after we created sales budget, we already identify, okay, let me point it some pen. I want, okay, this one. Okay, after we created sales budget, of course, we identify production sales unit. Okay, sales unit. Let's say you want to, the sales unit that you identify for that quarter is like 50,000. Can you ask the production unit, okay, just produce 50,000 unit? Can you do like that? Cannot, right? Because sometimes the product that you forecast to 50,000 already inside the ending balance. We already have 10,000. Okay, we already have 10,000 for which ending balance for last year, but we bring it this year. It will be your beginning balance. Beginning balance, 10,000. So if you ask production unit to produce 50,000 unit, so you will be wasted another 10,000. Okay, it will be extra 10,000 to be produced, which is 10,000 is money. All right, so that's why after we created this sales unit, we need to proceed to production budget. Why? Because we want to identify the production unit, how much we should produce actually, okay, out of this 50,000 to fulfill the demand. To fulfill demand. Okay, the demand is 50,000. Okay, we want to make sure that production is enough to cover 50,000 unit. Okay, now we proceed to production budget. Okay, how about this production budget? The production budget must be educated to meet budgeted sales. Okay, how and to provide the desired ending inventory. Okay. In company, they sometimes they want this much of amount of ending inventory. That means if that month they need to produce, let's say in April, they want to produce 40,000. Okay, they want 10% of next month sales, net sales. Because why? Because sometimes we want, if anything happen in May, let's say in May, no electricity, right? No electricity. At least we have 10% of May demand. May production, at least we have something to sell. They don't want to have, oh, we have nothing because we didn't prepare for it. So normally each company will have this portion to be kept into in ending inventory, so to be brought into next month. All right, so now we continue. The management of Royal Company want ending inventory to be equal of 20%. Okay, this is very important. Of the following month budgeted sales in unit. Okay, on March 31st, 4,000 unit were on hand. Okay, let's prepare the production budget. Okay, on March 31st, 400 was on hand. So that is ending inventory. So when we brought into April, this 4,000 will be your opening balance, opening or beginning inventory. Okay. Now remember we need 20% of next month for our ending inventory. Okay, how we want to do this production budget? Okay, first we put budgeted sales. How we get the budgeted sales? From the sales budget. So this unit, always remember, that's why sales budget is very important, because we will bring this number into production budget. And then this number that you calculated in the production budget is based on your sales budget. Okay. Then in this production budget, you will bring to direct material budget. So if you have, let's say you make careless mistake in your sales budget, so all your master budget will be wrong because you bring the wrong number here. Okay. Okay. The format is budgeted sales at ending inventory. So you get total need, then you less beginning inventory, and then we will get the required production unit to be produced for that month. Okay, now we start with April, 20,000. How we get this number? From the sales budget. Okay, we look at the sales budget after this. At desired ending inventory. How we get this? Desired ending inventory is 20% of the following month. So 20% of the May. Okay, now we look here. 10,000. How we get this 10,000? 20% from net sales from May. So 50,000 times 20%. So we get 10,000. We put it here 10,000. Okay. Then we get total need 30,000 here. Then we less beginning inventory. How we get this? In the question. They already give you 4,000 was ending inventory March 31st. On the 1st April, they will be your beginning inventory. Okay. All right. Ending inventory will be your beginning inventory in May. So ending inventory in April will be your beginning inventory in May here. Okay, so ending inventory in May will be your beginning inventory in June. Okay, that is how it works. Okay, what is the required production for May? Okay, we calculated after this 46,000. All right, so it will bring down here 10,000. Ending inventory in April will be brought forward into May as your beginning inventory. Okay, how you get this 6,000? How we get this 6,000? Anyone know? How we get this 6,000? Anyone know? How we get this 6,000? I just want to know whether you understand. Okay, 30,000 times 20. Yes, correct. Very good. So 20% from 30,000. So you will get 6,000. So this 6,000 will be bring down here as the beginning inventory. Okay. So we'll be bring down here 6,000. Okay, now the most important part. You have to do on the quarter. The quarter you have to total up here. Total up here you will get 100,000. And then you total up here you will get 105. And you total up here you will get 101. Okay, what about ending inventory and beginning inventory? Okay, this is the difference. You cannot total up. For ending inventory, take the last one. Take the last one. For beginning inventory, take the first one. So that is how it works. Okay, so April, May, June, then the quarter. The quarter will be just total up these three. Ending inventory, take the last one. Beginning inventory, take the first one. Okay, now we go back to the format. The format is budgeted sales from the sales unit. And then ending inventory, then you will get total need, then less beginning inventory. So how to get this desired ending inventory is 20% from the net sales. Okay, and beginning inventory normally ending inventory last month. Okay, that is how it works. That is how the format of production budget. Okay, now we continue to, okay, do you understand on the production budget? Once you understand the production budget, it's actually very easy to understand direct material. It's very easy to understand direct material. Do you understand on the production budget? It's very clear, right? This slide. Do you understand? For production budget, sales budget, at ending inventory, then less beginning. All right, very good. So now we continue to direct material. Okay, after we already identify here how many unit they need to produce in April, 26,000. How many unit to produce in May, 46,000. How many production they need to produce on June, 29,000 unit. Okay, and after we identify this unit, 26,000 unit, let's say units of cake. Okay, of cake. What is the direct material that we need in cake? Maybe the big one will be flour, right? Okay, and maybe butter, and maybe egg. Okay, let's say we already identified this 26,000 unit of cake, but how much flour that we need to buy? How much butter we need to buy for that April? How much egg that we need to buy for April in order to make this 26,000? Okay, let's say we need 2 pounds of flour for each cake. Okay, direct material, please buy 52,000 pounds of flour. Can we do that? Cannot, right? Because some of the flour is already in the warehouse. So we need to identify how many flour we need to buy by preparing our direct material budget. Okay, then after direct material budget has been identified, we need to buy the direct material. Okay, we need to buy. So that's why we have a schedule of expected cash disbursement for purchase of material. Okay, so direct material budget. Okay, at Royal Company, 5 pounds of material are required per unit of product. Okay, 1 unit, we need 5 pounds. Okay, then for April, we need 26,000 unit. So that's mean for April, we need times 5. So we need 130 pounds. So do we have to buy the 130 pounds of material? Then we have to prepare our direct material budget. Okay, the format is the same. format the same. We have ending, we have beginning. Okay, management want material on hand at the end of each month equal to 10% of the following month production. Okay, on March 31st, 13,000 pound of material are on hand. So this is our beginning balance. Then this is the desired ending balance. Okay, 10% of the following month production. Then the material cost is 40 cents per pound. So that means each unit we need 5 times 0.40 is $2 per unit. Okay, now we want to identify how much we need to prepare money in order to buy our direct material. So that's why they give us this info. Okay, so the format is said production material per unit. Of course, we want to talk about direct material, right? So we want to know the total material that we need for April, for May, for June. Okay, add ending inventory 10% for following production. Then less beginning inventory. Okay, it's almost similar. It's just that the material you have to multiply because we want to know the total production needs for direct material, and also we have to multiply with 40 cents. So we want to know how much the total direct material we need to purchase. Okay, so 26,000 times 5. We need to do this first because we want to identify production needs 130,000. Then we count the ending inventory. How we want to take this 23,000? Okay, how we get this 23,000? Because 10% of following month production needs. All right, then 20%, 10% from 230,000. Okay, so we get 23,000. So if anything happen next month, at least we can produce using this 23,000 of material. Okay, then beginning balance were given in the question 13,000. Okay, now we look at here. Ending inventory will be beginning inventory in May. Ending inventory in May will be beginning inventory in June. So this is how it works. Okay. See? So we'll be bring down here. Ending inventory in April will be beginning inventory in May. Okay. Then how do we get this 14,500? 10% from here. Okay. 10%. So from June. Okay. Ending inventory in May will be beginning inventory in June. Here, they bring it here. Okay, now we already get all this April, May, June. So you total up here, total up, and total up. Okay, how we want to record this ending? Of course, we will take the last one. For beginning, we take the first one. So that is only different with production unit. We just have to multiply here. That's it. Okay, the format is the same. Ending inventory less beginning inventory. Okay. Okay, this is actually the cash budget. Okay, after we identify this is the material need to be purchased. Okay, this is based on unit. How about total disbursement? Total money that we need to prepare in order to buy this one. 140,000 times 40 cents. So this one times 40 cents and this one we times 40 cents. So that's why we need to Roger purchasing department. Okay, can you buy 140,000 unit of material for production May? Okay, so that's why we need okay, if you can see here, this is our cash budget. So this is our cash budget. So this is the cash receipt that we calculate. just now for sales budget. So this is for disbursement for direct material, and then all of these number will be that we created in master budget will be posted into cash budget. We want to identify how much cash that we have. Okay, Royal pay 40 cents per pound for each material. Okay, one half of the month purchase is paid for in the month of purchase, and the other half will be paid the following month. Okay, same. If we buy from other supplier and that supplier also give us that term, okay, half you pay this month, next month you pay half, another half. So this is the term that we need to comply. Then the March 31st account payable balance is 12,000. So what we can do is almost similar with cash collection. It's just that this time around is the cash disbursement. What is cash disbursement? How much money that we have to take out to buy material. Okay. So similar, right? So account payable, this is the beginning for April. Then how about April purchase? Okay, we look here. We need to purchase 140,000. So this 140,000 actually you have to times with material per unit. Okay, material per unit. You can add on here. So this one is in dollar lah. So times 0.4 times 0.4 times 0.4. So you will get the number here. So this is 56,000. Okay. Is it 56,000? Yes, 56,000. For April purchase, half will be paid on April, another half will be paid in May. Okay, done with April. Then how about May purchase? Okay, May purchase is half you pay in May, another half you will be paid in June. Okay, what about June? Half you will be paid in June. So all of these you have to transfer it into cash budget. Okay, you have to transfer it to cash budget. So this is how we calculated for cash disbursement. What is cash disbursement? How many money need to be take out. Okay, take out, maybe take out for material. Yes, something like that. The meaning for cash disbursement. All right, until now, is it too much? Okay, I'm going very slowly so that you understand. How about now? Do you understand? Can you, am I going too fast? Is it okay? Then we can go to direct labor budget. Direct labor, overhead, selling, administrative, and cash budget. Actually, I need 2 hours for this. Oh, okay. For cash disbursement is actually is similar with cash. Cash disbursement is actually similar with cash collection. Okay, it's similar with cash collection. So what we can understand here, cash disbursement. What is cash disbursement? Is the total money that we need to take out, we need to spend in order to buy material. So what we can do here, we already identified the production unit right here. We already identified the production unit for that April. Okay, April here. This is only per unit. We need to calculate the total money. So we time with 40. This is already in the question. Total is 56,000 for April. Okay, we need to pay 56,000 for April, but the supplier also come with their term. Okay, 50% you pay this month, another 50% you pay next month. They said. Okay, so we pay half in April, another half in May. Okay, so here one half in month of purchase, another half will be paid in the following month. Okay, then this is the beginning balance. Okay, it's similar with cash collection. It's similar. So this is the beginning balance of 12,000. Okay, how about cash disbursement on April, which means we need to pay. We need to buy material for 56,000. So we follow the supplier term. 50% we pay on April, another 50% we pay on May. Okay, so we go to, how about May? Okay, May 50% we pay on May, 50% we pay on June. Okay, how to get this? Production unit times production direct material unit times 40 set. Okay, then how about June purchase? June purchase 50% will be time the total of June. Then we will get the total money that we have to disburse for this quarter. So it's 185,000. Okay, is it? Do you understand, Sabrina? So it's similar with cash collection. It's just that this is we are paying to supplier. So of course, the supplier will come with term and condition. If we want to take their material to supply our material. So it comes with the term, okay, 50% you pay this month, another 50% you pay another month. So all of these will be posted to cash budget. Okay, maybe we cover until selling administrative, then cash budget will be covered on this coming Friday. Okay. Now we go to, is it okay, Sabrina? Do you understand? All right. We go to direct labor. Okay, we go to direct labor. Okay, first we identify.
Yes, thank you.
Okay, thank you, Sabrina. Okay, first we identify the sales unit. Then we identify the production unit. Then we identify how much direct material we need to buy. And of course, in order to do this production unit, we have to pay our labor, right? We have to pay our employee. So how much we need to pay them? So that's why we have to prepare direct labor budget. So let's say this production unit, we need 0.5 hour per unit. So we need to produce 10,000. So 10,000 times 0.5, how much we need to pay our direct labor? So 5,000 hours. We need this 5,000 hours. So who will do our product if we not pay our labor? Okay, so that's why maybe we pay for them $10 per hour. So that means we need 10,000. We need $50,000 in order to make sure that we can produce this 100,000 units. So that's why we need direct labor budget, because we want to identify how much direct labor that we need to spend. Okay. At Royal, each unit of product required 0.05 hour, 3 minutes. Okay, 3 minutes only. Not sure what is the product. It can be a very small. The company have no layoff policy, so all employee will be paid 40 hours of work each week. For the purpose of our illustration, assume that Royal has no layoff policy. Okay, workers are paid at the rate $10 per hour for the next 3 months. The direct labor workforce will be paid the minimum. Okay, some of the question they will set a minimum. Let's say the minimum hour that you work for that month is 1,500. Let's say you work for 1,000 hour only. You will be paid 1,500. Okay, starting for 1,500. That is the minimum. So that is the term that your company already set. Okay. Maybe this is the term have been set in by the human resource in your country. Okay, your minimum per month you have to pay your workers is 1,500. Even though your workers work only 1,200, you need to pay 1,500. Okay, it's according to the question. If the question asks you to have minimum, then you will be paid based on the minimum. If your workers work more than 1,500, so of course we will pay on the time that they work more than 1,500. Let's say 2,000 hours, so you will pay 2,000 hours. Okay, so that is how the minimum hours work. All right. So unit of production is 26,000, 46,000, 29,000. We got it from production budget. Okay, direct labor per unit is 0.05. So we have to calculate the total hour they need in order to produce our production unit. So 0.05. So labor hour required for April is 1,500, May is 2,300, and 1,450 for June. Okay, now we have minimum hours, which is our minimum hours is 1,500. Okay, now please identify which of this month is less than 1,500. Which one? Which one? Less than 1,500. Okay, April and June. Even though it's less than 1,500, so we need to pay them 1,500 because it's the minimum. Okay, what about May? May is more than 1,500. Of course, we have to pay them based on this number because it is past the minimum. Okay, what we can do is this is guaranteed labor hours. So in April we pay 1,500. On June we pay 1,500. So this one is 2,300 because it's greater of labor hour required. Okay. Then how much per hour that we pay them? $10. So this is the total direct labor cost that we pay for direct labor. So April we pay 15,000, on May we pay 23,000, on June we pay 15,000. So the quota will be 53,000. All right? Okay. Now we move on. Okay, direct labor is quite easy. The direct labor is quite straightforward. Production from the production unit, from the production budget, then time, direct labor per unit, we need 0.05 per hour. Then we have this labor guaranteed labor hour required. Then guaranteed labor hour, this is 1,500. So April and June, because it's lower, we pay them 1,500. But on May, because it's greater than the minimum, we pay them 2,300. So this is the hourly wage rate. So we pay them $10 per hour. So this is a total direct labor. Then total direct labor that we pay. So we need to pay them 53,000 for that quarter. So direct labor budget is is a different format, but it's easy. Okay, how about okay, do you understand for direct labor budget? Okay, very good. So I will proceed to, okay, hopefully by 3 we can do our tutorial question. Okay, manufacturing overhead budget. Okay, for manufacturing overhead budget, we already aware that overhead, we have two types of overhead. One is variable, another one is fixed. Okay, this kind of budget, we need to identify how much manufacturing overhead will be spent on that month or on that quarter. So we need to identify the overhead within variable and fixed. So we need to add on these two, then we get our total manufacturing budget. Okay. All right. So we go to manufacturing overhead budget. At Royal, manufacturing overhead is applied to unit of product on the basis of direct labor hour. So they are using direct labor hour will be based on our direct labor budget. So we already calculated the hour, right? Okay. The variable, okay, that's why I say in manufacturing overhead we have two. Okay, one is variable, another one is fixed. Okay, the variable manufacturing overhead rate is $20 per direct labor hour. Okay, then fixed manufacturing overhead is 50,000 per month, which include 20,000 of the non-cash cost, which is depreciation. Okay, why they give us this information? Okay, now we look at the format. Okay, the format we will base on direct labor hour. So we will take this direct labor hour from our direct labor budget just now. So this is the total, the real total number, not the minimum. This is the total, the real number, 1,300, 2,300 and 1,450. So this is for the quarter. Then we times with variable manufacturing overhead rate for $20 per direct labor hour. So we get variable manufacturing cost here with this number after we multiply this. Okay, 26,000, 46,000 and 29,000. All right. Then we add with fixed manufacturing overhead cost, 50,000 here. 50,000. Okay, this 50,000 we get total manufacturing overhead cost is for 76,000, but we need to less with depreciation because it's non-cash. Okay, so this is the cash disbursement on the manufacturing overhead. Okay, all these we have to transfer to cash budget. Okay, so this is the format: budgeted direct labor times variable, add fixed cost, less depreciation. That is the only format that we need to remember for manufacturing overhead budget. Okay. Do you understand our manufacturing overhead budget? Add variable, find the variable and add fixed cost. Zip, can you understand? For the manufacturing overhead budget, we multiply with the variable first, then we get variable manufacturing overhead, then okay, we get plus fixed cost, then less depreciation. Okay, so that is a bit easy. Actually, master budget is totally easy. It's just that it's tedious. Too many things to prepare, but it's easy. Okay, now we calculate our ending finished good inventory. So from here, we want to identify how much the ending finished good inventory will be total. The total of ending finished good inventory. Let's say our ending inventory just now, based on the production, is 5,000. Okay, now we want to calculate our product cost. How much is product cost? Because we already know our direct material, how much, our direct labor, how much per hour, and our manufacturing overhead. Okay, for manufacturing overhead, why it come out that this? Okay, it's come out this because we want to know our predetermined overhead rate. Predetermined overhead rate. So that we can put this number into our product cost. Okay. So 251,000 divided by 5050. So this is the then we calculate our product cost in ending finished good. So this is how we calculate our product cost. Direct material, £5 per unit times 40 cents. Okay, hopefully you remember the number. Okay, direct labor is 0.05 per hours per unit times 10. times $10.50. Then manufacturing overhead 0.05. We are following direct labor because manufacturing overhead is based on direct labor hour. So 49.70. So this is the based on the manufacturing overhead that we calculate. So every product, every unit will cost us 4.99. Okay, now we want to calculate ending inventory only. Ending inventory. So this one is from your production unit, 5,000. 5,000, then times 4.99, you will get ending finished good inventory for 24,950. So this is our ending finished good. Okay. Okay, the last one for today. So tomorrow we will calculate for, I will continue for the cash budget. All right, selling administrative expenses budget similar with production budget. Okay, no, sorry, similar with manufacturing overhead budget. Okay, the format is similar. We have variable here, we have fixed. Then add on these two, then we less depreciation. That's it. At Royal, the selling administrative expenses budget is divided into variable, on variable and fixed. Okay, the variable selling and administrative expenses are 50 cents per unit sold. Okay, the fixed selling administrative is 70,000. Okay, include 10,000 of depreciation. So we already know the format and almost similar. So budgeted sale, this is based on sales budget. Because we are doing selling, we are not doing production. Okay, we are doing selling. This is from sales budget. Okay, 20,000 times 50 cents. From this question, 50 cents. Then we get 10,000. Add fixed expenses from the question here. Then we less with depreciation 10,000. So we get cash selling and selling administrative expenses for April. Okay, what about May? Okay, May is 85, June is 75, and quarter is 230. So all of this sales budget, production unit, direct material, direct labor, overhead, selling administrative will be posted into your cash budget. Everything, okay? We post in cash budget. From the cash budget, we identify how much cash that we have. Is it enough resources to start our production for that quarter? So that's why we need master budget, because we want to identify whether we have enough resources. Then we can identify our bottleneck, whether is it the machine is enough to cover the production. If the production is 10,000 unit, we need 5,000 hours. So, but the machine is only capable to produce for 4,000 hours only for maximum capacity. Okay, then we have to plan again. Okay, so that's why we need master budget. All of this number is actually a budgeted. The production didn't start yet, so that's why we need this master budget. All right, so we finish with anti-selling administrative. Okay. I have to stop recording.